Hey everybody, Joseph Gosling with Eureka Business Group. We are Texas multifamily investment specialists, and today we're going to talk about the top 5 mistakes multifamily buyers do when analyzing multifamily properties. Mistake number 1, forgetting to include an increase in property taxes. The minute you're going to buy a property, the county is going to come knocking. This is guaranteed, right? They're going to want more property taxes. And yes, there are some counties that are more aggressive than others, like Collin County and Dallas in Texas. But regardless of the aggressiveness, they will all reassess your property. And don't get that fake safety on non-disclosure states, right? It doesn't matter if you're in disclosure state or non-disclosure state, they will come after you. In a full disclosure state where you have to disclose how much was the transaction and how much you paid to buy the property, then it's very easy. They're going to do the math based on the assessment formula, and you're going to get the new assessment immediately the following year. Some of those counties actually offer you the formula online, so you can do the math yourself and put it in your underwriting. In your non-disclosure state, they're not stupid. They're going to figure it out. They're going to look at the loan you're going to record on the deed. They're going to look at transactions that happened around it, and they're going to put an assessment value that is dramatically higher than what the previous owner had, especially if it's an older ownership. Now, with that in mind, always put those numbers as if they're going to come and increase the very next year the assessment. That's just the way it is. Account for it, and you will not be surprised when that tax assessment comes in the following year. Mistake number 2 is using industry benchmarks, right? And industry benchmarks are based on averages, and they're awesome, but it's easy, it's good to use when you do a high level analysis. It's really, really bad when you base your underwriting on it and that's all the numbers you're using. Because let's face it, not all properties are built the same way. And just a few examples on it, right? If you have a 200 unit property sitting on, let's say, 2 acres of concrete in an urban environment, the landscape costs on that one are going to be very small versus a 200 unit property that sits on 20 acres of grass. Can you imagine how much landscape costs you're going to have in contracted services on those 20 acres of grass? So that's just one example. Plumbing expenses, when you have a 50 unit high rise versus 50 unit spread over 10 buildings. HVAC repair costs, when you're looking at a newer property that has individual HVACs, or you're looking at an old 2-pipe chiller system somewhere in Arizona. And snow removal costs, which probably going to be very high in Boston versus completely non-existent in Texas. So looking at industry benchmark is good for the high level look at the property, but as you get nearer into putting an offer on a property, you really want to drill down to what this property is going to have in contracted services, in expenses, in materials, and so on. So watch for that. Mistake number 3 is forgetting to consider inflation. And inflation is part of life. Inflation happens every year, everywhere, and if it slows down, the Fed increases rates just to make sure it does happen. So this or it doesn't go too much. So there's financial bodies that will make sure that we're making our targets in inflation. So you should not be forgetting the fact that there is going to be inflation. So everything is going to cost more. Payroll, maintenance costs of parts, your contracted services, your property taxes, your insurance, everything will rise just because the dollar is going to get eroded with inflation. So make sure you build inflation into your underwriting model, making sure that costs, even if there is no major change in the property, costs will creep up year over year. Mistake number 4 is getting started with $0 in the bank or not including an operational reserve. Multifamily properties don't operate on thin air, right? Once you get control over the property, you're still going to have to pay salaries and pay your vendors and put deposits on your utility accounts and so on before you start collecting. Now, if you set your closing to the 31st, awesome, right? You might have a little bit of money in the bank before you get started to put all these things, but I wouldn't bank on it. And There is no rule in the universe that says that 2 days after you take over the property, the $20,000-$30,000 boiler doesn't die. And then you're looking at a big expense out of the blue that you didn't plan on, and you have no reserves. So when you do your underwriting, make sure that you have enough money in the bank account to start operating and be ready for surprises before money gets accumulated in your capital reserve account. If you have a loan that rolled some of the rehab costs into the loan, most banks operate in a way that you're going to have to fund the costs to the vendor. Let's say you have a new roof. You're going to have to fund the new roof with the vendor. And then on the back end, when it's done, the bank will send an inspection. They'll take a look, verify you did the job, look at the invoice and the check that was paid, and then reimburse you from that rehab reserves account. That means you need money in the bank to be able to front those expenses. And then another variation of this mistake is undercapitalizing and thinking that you're going to do all the rehab from the operations budget. Like I said earlier, life happens, surprises happen, and the operational budget is for operations. It's not for rehab, it's not for CapEx work. So make sure you build an operational reserve account into your underwriting as you look at a property. Mistake number 5, our last mistake, is assuming that the current expenses matter. Well, that when you get a P&L, when you get a T12, when you get a look at the seller's financials, it's good and it's nice for a reference, but it should not be taken as is. Sometimes the numbers are just incorrect, and that is a nice way to say I've seen some of those being fudged, right? And many times these numbers are just not relevant to you. And here's just a few examples of what I'm talking about, right? If the seller's brother is the pest control guy and he gives it to the seller at cost, you're not going to be able to get that same price for pest control. So assuming that you're going to pay the same amount that seller does is based on an assumption that might or might not be true. And other examples, I've seen owners that owe thousands of units in the vicinity of that property, and their scale allows them to get the best price out of their vendors, or they do a lot of things in-house. For example, I know a guy that has his own construction crew. He has his own painting crew. He's got his own carpet and flooring crew, right? But if it's your first 20 unit, you don't have that operation efficiency. You don't have that scale. So assuming it's going to cost you the same it's going to cost him is not realistic. Other examples, right? We've seen sellers that keep the same manager for over 10 years and they just give them pay raises year over year, getting to the point where they're paying double the industry standard, right? Would you do that? Would you pay double the industry standard for a manager you just got? Sometimes we've seen people that have smaller properties like 30, 40 units with full-time staff. Well, these are too small to sustain full-time staff, right? So would you reduce the payroll? So all I'm saying here is take a look at the seller's numbers, but also make sure that in your underwriting, you're applying the numbers that you can get. The numbers that your vendors are going to get you, the cost that your property management is going to cost, the number of people that you're going to put on the property, and so on. So make sure you look at their numbers, but you adjust and adapt to your underwriting and your circumstances. That's it. That's the top 5 mistakes as a broker I've seen around buyers do. Make sure you go through those. Make sure you have any questions. Feel free to reach out to me. My phone number, my email, my website is all on the screen. And as you can see, we have over 500 units. We're not just brokers. We're also owners and operators. So feel free to reach out to us. We can help you with whatever commercial real estate needs you might have.